So yeah, so let me just give a quick introduction over here. I think we're kind of settling in and still waiting for our speaker. Just send him a quick message, making sure he didn't forget about this. Although I did speak to him about a few hours ago and he was on board. So listen, if he doesn't show up, I'll just have to talk about taxes. And I'm not a CPA, but I play one on TV, and that's what I do best. So anyways, our format here, as a lot of you know, for our newcomers, for what we do, we have a speaker. Usually we get to speak on a topic every week, a different one for about anywhere between 30, 40 minutes or so. Hopefully it's a good topic, something intriguing. If you have suggestions of topics or speakers that you might like to have in the future, please feel free to reach out to me and, you know, drop me a line. You know where to find me. If you don't know where to find me, then I don't know how you found me, but you did somehow, so you're doing something right. But LinkedIn, definitely, that's kind of the hub right now. I'm in the process of making a Facebook group because I think that might be a great place to kind of congregate, if you will, or kind of make it a little more centralized. I got some people on LinkedIn, some people from Bigger Pockets, some people from Facebook. And so just kind of make it a little more centralized to communicate. And then we break out into these in breakout rooms. So I think, I'm not sure if we're going to have Brandon Hall today. So let me just get a quick start and say a little bit about myself, since maybe you guys, you don't know who I am. This is the first time here or whatever. Brandon just joined. Great. So I'm Yona Weiss. I'll introduce Brandon in a second. Is there a way to like get him at the top of the screen? No, he's going to be at the bottom.
Yeah. Sorry, I like totally thought this was a 7.
Oh, you're right in the middle. Okay, well, I'm glad you're here. Okay, so I'm Yona Weiss. For all of you who don't know me, we do cost segregation by day, real estate networking by night, LinkedIn 24 hours, every other waking hour. So if any of you guys have any questions regarding this, and again, like I said, future meetups, please feel free to reach out to me over there or anywhere. And without further ado, I want to introduce Brandon Hall, CPA, CEO of Real Estate CPA, which is a virtual accounting, real estate focused accounting firm that he started a number of years ago after working for several other, kind of mainstream corporate accounting firms. Wanted to do something a little bit different, shake up the world, and kind of revolutionize the accounting from a virtual standpoint, which now is getting much more popular. So now, Brandon, you've become an expert and a thought leader on that subject right at the time when everyone needs it. So I think that's pretty incredible. He's also a real estate investor himself, a syndicator, and a capital fund that invests in different assets. So without further ado, Brandon, if you want to speak a couple words more than anything I missed. Oh, he's the host of the Real Estate CPA podcast, very popular podcast, which you can learn all kinds of stuff about taxes and relating to real estate, as well as a brand new podcast that you just started. I saw a week or two ago. Is that right?
Yeah. The Staying Power podcast. Yep.
Staying Power
Pod. Yeah, we interview business owners about their pains and struggles and how they made it through. So, yeah. Well, thank you very much for having me. And I apologize for being late. That's not normal for me. But I thought it was 7:30. So thank you for sending me an email. Thank you for having me here as well. How do these normally go? Do you ask questions, or do you want me to just launch into kind of talking about some different things?
Yeah, I like to do it. I think, at the beginning, like just go into some things. If you have slides, you just want to share whatever you want, kind of whatever you want to do. And then we end up, I think, at a certain point, we'll ask questions and we'll kind of go from there.
Sure. So I don't have slides, and
okay.
I'm just not very big slide guy, which is good and bad when I do the presentations, I guess. But
right.
I do have something that I built out for the Tax and Legal Summit that I can send you after this. It's on real estate professional status. So why don't we do this? Why don't we talk about real estate professional status? We can talk about the net operating loss provisions in the CARES Act and how that coordinates with cost seg and bonus depreciation. Is that going to be you think that'll be okay?
Those are great topics.
All right.
So
sweet.
Let's do it.
So let's do this. If you own single family rentals, type 1 into the chat box. If you own multifamily, type 2. And if you own short-term rentals, type 3. So single family is 1, multifamily is 2, short-term rentals is 3. Go ahead and type a number into the chat box. I see a lot of single family and multifamily. I see some short-term rentals. Cool. We got a 1 and a 2 and a 3. All right, sweet. So we got a good diverse crowd here today. It looks like maybe one person with short-term rentals. Short-term rentals are a fun spot, which I'll talk about here in a little bit. So let's talk about real estate professional status. We're going to talk about real estate professional status. We're going to talk about what was in the CARES Act that can potentially help you out as a landlord, and then we'll talk about short-term rentals and how you guys are a little special in a good way. So real estate professional status. Real estate professional status is the apex of tax planning for landlords. If you get real estate professional status, you will save a ton of money in taxes. And before we explain what real estate professional status is, we have to first understand what rental activities are typically treated as. And what we do is we look to Code Section 469. So Internal Revenue Code Section 469 defines rental activities as default passive activities. And what that means is if I have a rental activity that's producing income, it's considered passive income. If I have a rental activity that's producing a taxable loss, it's considered a passive loss. And that's just the default treatment with rental activities. In rental real estate, a lot of you own rental real estate, so I'm sure that you have figured this out, but you can positive cash flow and show the IRS that you actually lost money. And this is largely thanks to depreciation and different things that we can do with the 2013 tangible property regulations. So I can positive cash flow 10K, hits my pocket, but then I can go tell the IRS I actually lost 2. And that $2,000 loss is a passive loss by default per Section 469 of the tax code. There are 2 exceptions to the passive activity rules. And the exceptions essentially switch our treatment of the passive losses from being passive to non-passive. And the importance of this, the important thing about having a non-passive loss is that non-passive losses can offset all of my other income without limitation, at least until 2021, where the excess business losses come into play, which we're not going to talk about because we don't have enough time. But in general, if I have non-passive losses from my rental real estate activities, I can use the non-passive losses to offset all of my other income. That's when we loop people like Yona in to do cost segregation studies. We'll claim first-year bonus depreciation, and we'll basically just crush our tax return with these non-passive losses, right? But if I don't meet one of the exceptions to Section 469, there's 2 exceptions, which we'll go over in a second. If I don't meet one of those exceptions, then it doesn't matter what I can do the cost seg study. I can get the 100% bonus depreciation. I can boost my losses, but at the end of the day, they're still passive. So it's still going to be a passive loss. So a passive loss can only offset passive income from other passive activities or the gain on sale from passive activities. So I could sell a rental property or a stake in a syndication, and that's a gain on sale from a passive activity that my passive losses can then offset. So, and that's a question we always get. If property A produces a passive loss, but I sell property B, can property A's loss offset property B's gain? Yes, it can. But if you meet one of the 2 exceptions, then it doesn't matter because now you've got non-passive losses and they can offset everything. So if we don't meet the 2 exceptions, we have passive losses and we're stuck in the passive category. We can only use the passive losses to offset passive income or to offset gain on sale from passive activities. And if we have no passive income or if we have no gain on sale from passive activities, then our passive losses are suspended indefinitely until they can be utilized to offset the passive income or the gain on sale from passive activities. And if you have any questions as I'm going through this, feel free to throw it into the chat. All right, so there's 2 exceptions to the passive activity rules. And the exceptions get us over the default treatment that all rentals are passive. The first exception is if I earn less than $150,000, I can claim up to a $25,000 passive loss. It's called the passive loss allowance. It starts to get phased out once my income goes over $100,000. and it's phased out $2 for every $1 I'm over 100,000. I think I said that right. Yeah. So when I get to $150,000 in income, my $25,000 passive loss allowance is now zero because I've reached the total phase out. So that's exception number one. Pretty simple. Exception number two is real estate professional status. And this is what everybody loves talking about. It's in all the books. It's the marketing stuff. It's the sexy thing that gets people jazzed up whenever they're investing in real estate. But it's also a pretty complex piece of the code. And it's a piece of the code that not a lot of CPAs get right. And sometimes the IRS doesn't get right. And sometimes the tax court does not get right. So it's pretty complex, and it's important to follow all the rules and substantiate your position very thoroughly. So real estate professional status. If you work 750 hours and more than half your time in a real property trader business, you will be considered a real estate professional for tax purposes. And it's important to understand that all that matters are the hours, right? You didn't hear me say you have to have a real estate license. You didn't hear me say you have to do a certain type of activity. All I said was 750 hours and more than half your time in a real property trader business. So real property trader business can be leasing, can be brokering. So you can be a real estate agent and you can track all your time, and you can be a real estate professional if you're being a real estate agent. And as long as you hit 750 hours and more than half your time. It can be construction, it can be building, it can be development, it can be landlording, property management, anything that is like kind of dealing with the way that I like to describe it is if you have a role in making a property go, right, from start to finish, acquiring or building it from scratch, acquiring it, putting brokers to buyers together, sellers together, managing the property, selling the property. That is all stuff that's going to make the property go. All of those hours are going to count for real estate professional purposes or real estate professional status. Now, who is automatically excluded from real estate professional status? Everybody that has a W-2 job full-time. It's never gonna work. All right. And there have been a lot of people that have tried, and every single one of those people have lost in tax court. Every single one. The only one person who had a full-time job and won was a boat pilot, and he didn't actually work full-time as a boat pilot. It was like one of those like part-time things. So we have airline pilots in our client base, and we'll claim them as real estate professional, even though it's a full-time job. They're not actually working full-time, right? And that's the key. Teachers can be a good example of people that can qualify as a real estate professional. But teachers can also be people that really screw it up. There's a couple tax court cases where the teachers only counted their work hours, their W-2 hours from opening bell to closing bell, totally disregarded all the time grading papers, going to conferences. Tax court was like, that's not realistic, right? So we have to be really careful if we have a full-time job or if we're being paid for a full-time job.
Couple questions. Yeah. So sure. One question about being paid for a full-time job. What if you're in a real estate, you work for a real estate company, right? You're an acquisitions guy in a real estate company. Or another question in the chat here related to that, you work for a real estate financing company, right? A mortgage lender, broker, you're underwriting deals, et cetera, all day long. Are either of those in the realm of real estate?
Could be. So you have to own a stake in the employer. It has to be 5%, minimum 5%. So that typically weeds most people out. The other thing, though, you mentioned mortgage brokers. I believe it's 2017. I don't have the case off the top of my head, but it was 2017. There was a court case that dropped. It was a mortgage broker that owned his own brokerage, and he was claiming real estate professional status. The tax court said that is not a real property trader business. That is a note business, the lending business. So I, as a CPA, I provide tax and accounting services to my clients, even though every single one of them is in real estate. Because I provide tax and accounting services, I'm not providing real property services. So you just have to watch out for the nuances there. So again, and that's why I say you've got to be like kind of going down to the property and touching it. You've really got to play that role in order for those hours to count.
Okay, awesome. Another question here related to that. What about syndicating a deal? And that's a really broad question, but I'm sure you deal with it a lot because most of a lot of your clients are involved in those as well. And that can mean a lot. There are a lot of different roles in a syndication, and how does that play out?
Yeah. So when you're syndicating a deal, first off, if you're on the LP side, those hours will never count. They're not going to count for real estate professional, and they're not going to count for material participation. You have absolutely no control. You have no vote. You can't influence decision making, so it's never going to count. If you're on the GP side, it could count, but it depends on your role and it depends on what you do. If you're just meeting with the GP on a monthly basis to go over property performance, that's an investor level activity. That's not, I'm not managing the property. I'm not managing the property manager. I'm not making the property go. And that's honestly what kills a lot of the GPs that we work with. You know, they do a ton of the work on the acquisition side. All those hours count, right? All the putting the deal together, getting everything situated. Then they go green and they turn the deal on and they buy the deal and they hand it to a property manager. And then they're just talking to the property manager once a month because the property manager is so good at what they do. And then the hours don't count because it's just investor level activities at that point. So hopefully you've got a couple deals where you've spent all that time where you're going to hit those thresholds. Generally speaking, syndicates, it's not a big deal. You're going to be able to count most of the hours and you're going to be able to qualify. But we have seen it where people don't. And when we typically, the general partners in the syndicates where we typically say, hey, you're not going to be able to count these hours, it's typically the folks that are raising the capital and they're just bringing capital to the deal. That's not going to be a real property trade or business activity. It's more like the mortgage broker activity at that point.
Awesome. Yeah, that makes a lot of sense. And in terms of the actual, and what are the things that you would tell those syndicators to be, I mean, maybe you were going to get into this, but in terms of actually tracking those hours, or for the real estate professional in general, I get asked this question a lot, and I want to ask you.
Yeah. So you have to track your hours. It's not a question of should I or what if I don't want to. You have to. And we actually just last year started telling our clients, we're not going to claim real estate professional for you unless you give us an hour log that we can look at. And we did that for a number of reasons, but one of the things that prompted it was there was an EA out in, I believe, Southern California who's now in jail, and he was claiming real estate professional status for all of his clients that owned real estate since 2010, and they all got audited. And we ended up with like 15 of their clients and, you know, helping them through some audits. And some of them, it was like way too late. They're at the tax court steps. There's nothing that we can do at that point. But one of the things that the court basically, the court like disbarred him and all that, but left the business open. So he still has associates there. But one of the things that they said is you're not allowed to claim real estate professional status unless you get the time log. And then we were like, oh, well, that makes perfect sense. Like, why don't we just do that too? So we're not going to claim real estate professional status unless you give us a time log. And we think that it makes it kind of just forcing that substantiation on an ongoing basis, because here's the problem. If you don't keep your time and you get audited 6 years later, you're going to go back and retroactively try to build your time log out. And you're going to end up like a woman who, in a tax court case that dropped March 2018, she has 8 properties, 10 units. She retroactively built her time log out. Tax court subpoenas her credit card statements and basically says, hey, we think that you could be a real estate professional for tax purposes. But when we look at your time log, there's a ton of examples where it says you're at the rental property on a Saturday, but then we pull your credit card statement and it says you're in London traveling because you're swiping your credit card in London. So we can't trust what you've given us. Therefore, we're going to deny your real estate professional status. So tracking it on an ongoing basis is the key thing. But we've seen a lot of methods. It doesn't really matter what you use as long as you do it. You can use a handwritten notebook. You can use a Google Calendar or a calendaring tool. A lot of our clients use Google Sheets because it can also be an iPhone app, which is just really easy. It's really up to you. It doesn't matter, but we won't claim it unless you give it to us. So real estate professional status. So we've clearly said if you work a full-time job, it's not going to count. Now, sometimes I'll tell clients this and they'll come back to me and say, well, but like I really only work 38 hours because I'm not really working the full 40 hours and I take vacation and like all that stuff, right? And I'm like, well, first off, maybe you should go to your employer and like have a conversation with them about that. But second off, the tax court's going to go to the employer and they're going to say, how many hours are you paying them for? And if they say 40 hours a week, they're going to take that over anything that you tell them. So that's the hurdle. And so you're going to have 2,000 hours a year that you're going to have to get over. That means you're going to have to spend an additional 2,001 hours in real estate. It ain't never going to happen. So And if you have a CPA that's willing to claim, that's the other thing that's really tricky about this stuff, guys, is that there are CPAs that don't understand the nuances. And so they'll go, oh, yeah, we can claim it. You've got a nice portfolio and you've got a full-time job. We'll claim real estate professional status. Find a different CPA, man. You're going to end up under audit and it's going to be real painful. This is not one of those areas of the code where you find the person that tells you what you want to hear. You need to find the person that's going to tell you what you need to hear and then figure out the strategy to get it done. So real estate professional status. So that's step one. We've got 2 steps to make our losses non-passive. Remember, we're on this quest to make our rental losses non-passive at the end of the day, right? So
one more before you get to steps 2. One more
Sure.
question on 2 more questions on the real estate professional status. So one thing you didn't touch on, which I think is important, is that it's either you or your spouse that
That's
can have this
later in life.
status. Oh,
yeah.
gee.
That's okay.
I got you.
Part
Okay.
of step 2.
Oh, it's part of step 2. I thought it's all part of step 1. Okay.
It is, but I explain it in step 2. But you're
All
right.
right.
You're right.
My bad, Brandon.
It's all good, man. It's all,
Okay,
you're
go
too
ahead.
smart for this. You're too smart for this.
No, I apologize that I even assumed that you may have omitted that, you know.
It's all good. It's all good. All right. So real estate professional status, qualify as a real estate professional. Qualifying as a real estate professional means absolutely nothing. And that's the thing that always rocks everybody's boat. It's like, what do you mean? You just went through this whole thing about real estate professional status and how important it is. But qualifying as a real estate professional means absolutely nothing. It doesn't do anything for you. And the reason for this is that you could be a real estate agent and you could hit all your hours as a real estate agent. So you can be a real estate professional status as a real estate agent. And again, it means absolutely nothing as it pertains to your rentals. And that's where we get hurdle number 2. We have to materially participate in our rental real estate activities. So I have to be a real estate professional, and then I also have to materially participate in my rental real estate activities. If you are being a landlord full-time, if you're syndicating deals full-time and you're hitting real estate professional status on those hours, then you're automatically going to hit material participation. But where material participation throws a huge curveball into this and is a big hurdle is for people that are in construction full-time. They are wholesaling. They're a real estate agent full-time. Those people are all going to be a real estate professional. But if they don't also materially participate in their rental real estate activities, then their losses are still passive. Real estate professional status means absolutely nothing. So you always have to hit those 2 things. Material participation, there's 3 tests that we normally see. It's greater. The first test and the easiest test is I've completed most of the hours on the property and nobody else has really completed anything. The second test is I've completed at least 100 hours and more than anyone else. So if I've got a property manager who completed 107 hours, I need to complete 108 hours, 100 hours and more than anyone else. The third test is a safe harbor, and it's just I've spent 500 hours materially participating in my rental real estate activity. So there's technically 7 tests of material participation, but those are the 3 that we see most often, and you only have to hit one of them. So if you're self-managing your rental real estate portfolio, you are probably already materially participating just based on that first test. You're completing substantially all of the activity. Material participation in real estate professional, to hit the hours, as Yona was alluding to, I have to hit real estate professional status by myself. My spouse has to hit real estate professional status by themselves. So my spouse can be a real estate agent. She hits real estate professional status by herself. My hours don't count towards her. Her hours don't count towards me. But for the purposes of the second hurdle, the material participation hurdle, we can combine our time to hit those tests. And this is important because what this means is that you don't have to force your spouse. Like if you've got a full-time job, you don't have to force your spouse to manage the rental real estate activities. Maybe your spouse just wants to be a real estate agent. Cool, go be a real estate agent. You hit real estate professional status as a real estate agent. I'll do all the rental activities. And you're going to hit real estate professional status. Then you're going to be able to count my time for material participation purposes on the rental real estate activities. And then we'll hit the non-passive loss threshold. Really important there. You have to qualify by yourself for real estate professional status, but then for material participation purposes, you can combine your time. So if we do all that stuff, then we've got non-passive losses. And then it's just the start. It's the start to what's next. Now what do we do, right? And what we like to do is we like to say, well, let's boost this as much as we possibly can, especially in 2020. So to boost our passive losses, we'll pull in somebody like Yona, and we'll say, hey, we want to cost segregate these properties. And if I buy a $500,000 multifamily property, I could probably get $200,000 in first year bonus depreciation. That bonus depreciation, if I've got non-passive status, non-passive loss status, because I'm a real estate professional and material participation, that $200K bonus depreciation might yield $180K in non-passive losses. I can now use that to offset my business income, my W-2 income, my capital gain income, my dividend income, my Uber shares that I'm liquidating, whatever income that you've got, you can offset with non-passive losses from rental real estate. Super important in 2020, because with the CARES Act, we now have net operating loss provisions that are going to expire December 31st, 2020. And basically these net operating loss provisions allow you to carry a net operating loss back 5 years. And that's important for real estate investors who qualify as a real estate professional. Well, or who can create non-passive losses is what we're really getting at here. You can't do it with passive losses. So I can create $1 million of passive losses, does absolutely nothing for me as it pertains to the net operating loss provisions. But if I create a lot of non-passive losses and those non-passive losses exceed my income in 2020, all of my other income, then I've got a net operating loss. And that net operating loss can be carried back 5 years. We always go back to the earliest year. So if it's a 2020 net operating loss, we'll go back to 2015, which is actually beneficial because marginal rates were higher at that point. So you get a couple extra percentage points on your cost seg study analysis and your net operating loss provisions. Or your net operating loss in general. So really good stuff if you can do it.
Yeah, can you, just for the people that joined in the sake of everyone, just for re-clarification, because I know, a lot of people here own properties, but there are some beginners also who are wanting to learn and getting involved. So you just clarify one more time the difference between passive losses and non-passive losses.
Sure.
You touched on that a lot, but there's a big differentiation.
Yep. And it's important. It's really important. I'm glad you asked, because it's really important to understand the difference. The difference can literally save you tens of thousands, hundreds of thousands of dollars in taxes every single year. Passive losses, that's the default status for rental real estate activities under Section 469 of the tax code. Section 469 defines rental real estate and defines rental real estate as passive. Default treatment is passive. Passive losses can only offset passive income or gain on sale from other passive activities. But if I qualify for one of the two exceptions, one of which was real estate professional status, which we've been talking about, then I can reclassify my passive loss or my passive activity as a non-passive activity. And if that non-passive activity generates a loss, it's a non-passive loss. I can now claim that non-passive loss against all of my other income. It's not limited to my passive income or gain on sale from my passive activities. So really powerful stuff there. So I want to touch on, so in the CARES Act, the net operating loss provisions are big if you can create the non-passive losses. If you own commercial real estate, there's qualified improvement property in the CARES Act. They've redefined it. There was a technical error with the 2017 Tax Cuts and Jobs Act. They accidentally left qualified improvement property as 39-year property. The CARES Act has changed that. It's now 15-year property. We've got a small subset of our client base that's commercial property owners, and they were all elated because now they're going back and we're taking 100% bonus depreciation on all of that qualified improvement property. It previously did not qualify for 100% bonus depreciation because of that 39-year life that it was assigned. But a nice change there for anybody that has commercial property. And qualified improvement property is any interior improvement made to the property as long as it's not structural. So if I have a Burger King and I rehab the entire kitchen, I put $1 million into it, it's probably $1 million worth of qualified improvement property. And I can immediately expense that with 100% bonus depreciation. At least I can now. But if I had done that in 2018, my 2018 tax returns, I would have had to capitalize that $1 million. So now we get to go back. It's retroactive. So we get to go back and say, oops, I capitalized it. But with the CARES Act, it's now 15-year property. I'm going to go change this. I'm going to take $1 million loss. So really nice provisions there. But that's kind of the key stuff that's in the CARES Act, the net operating loss provision and the qualified improvement property. There's some other small tweaks and things that are also in there, and some that are significant, like the business, the excess business loss limitation. That's going to kind of cap what you can do as a real estate professional, that status going forward. But it starts 2021, and we'll put out a ton of content on exactly what that looks like at some later point. It's kind of complex. So really good stuff there. So at the end of the day, we're trying to get to non-passive loss status. Now, the reason I asked about short-term rentals, short-term rentals are not considered a rental activity under Section 469 of the tax code. All right. And so remember, we just spent 35 minutes, or well, I guess 29 minutes because I was 6 minutes late. We spent 26 minutes talking about Section 469 of the tax code, where it defines rental activities as all being passive, and you have to qualify as a real estate professional to make them non-passive. But if you have short-term rentals, they are excluded from the definition of rental activities under Section 469 of the tax code. So what does that mean? Well, it means that you don't have to qualify as a real estate professional in order to take the losses, which means that you can be a full-time W-2 employee and you can buy a ton of short-term rentals. You can cost seg all the short-term rentals, and you can take your losses as non-passive as long as you materially participate in the activity. So short-term rentals, much lower threshold. All you have to do is materially participate in the activity in order to claim the losses as non-passive. You do not have to be a real estate professional for tax purposes. On the flip side, if you're also trying to qualify as a real estate professional for your long-term rentals, your short-term rental hours are not going to count towards real estate professional status. Because again, short-term rentals are outside of the scope of Section 469. So this is really cool. It's cool for a number of reasons, right? One, if you have short-term rentals, go check out your Schedule E. I guarantee you I would be willing to place a good chunk of money on it that your tax preparer has treated your short-term rental activity as passive on Schedule E. That's typically what happens. And you report them on Schedule E unless you are providing substantial services while the tenant is there, right? A lot of people think, well, I do all the cleaning and I do it. Well, if the tenant's there and you're doing it while they're there, that's substantial services. That's a Schedule C activity, right? But if you're not doing that, then it's always a Schedule E activity. And most of the short-term rentals that we work with are all Schedule E activities. But it can be on Schedule E with all of your other long-term rentals, and it could still flow through as non-passive, as a non-passive loss, while all of your other rentals are passive. Really, really important to double check your tax returns if you have short-term rentals, anything that you filed in the past, because hey, right now everybody's looking for money, right? How do I get a little bit of extra cash to carry my properties, especially if you own short-term rentals? and that's a good way to do it. Go back and amend some tax returns.
Yeah, and quick question here from one of our participants here. What is the definition, if there is one, of a short-term rental by the tax code?
Average stay per tenant is less than 7 days, or less than 30 days and substantial services are provided. I think that was right. And substantial, 30 days and services, or just less than 7. Most of our clients hit the less than 7, and that's how it works. To find out what that average stay looks like, you look at all the days that it was rented, look at all the tenants, divide them. That's your average. So you could theoretically, for the first 6 months, rent a short-term rental on a really short-term basis, and then throw in a long-term tenant there for the remaining 6 months. And as long as in the aggregate, it's still an average less than 7 days, you've got a short-term rental, even if it's long-term today. And it's also year by year. So you could have had a short-term rental in 2019, maybe in 2020 with COVID, you switch it to long-term, you take it off that short-term market. Hey, 2019, it was still a short-term rental. So where's the opportunity with something like this? Well, everybody with short-term rentals that I'm aware of is getting hammered right now because there's just not a lot of travel, not a lot of people going out and picking up short-term rental stays at this point, right? They're not vacationing. So what's going to happen? And what's already happening? You're seeing a lot of the short-term rentals start to come on market. People can't carry them. They can't float them. So they're going to liquidate them, which means that you can go in, if you're well capitalized, you can go in Q3, Q4, 2020 here, buy the short-term rentals up. You rent them out on a short-term basis. You cost seg them all. Now you've got a lot of non-passive losses. A lot of non-passive losses that you're able to claim against all of your other income. And you can do this even if you have a full-time job. That's the key. That's the big loophole, I guess, is the fact that you can have a full-time job but still claim your rental real estate losses as non-passive because they're short-term.
Sounds like a big provision, because in the end of the day, short-term rentals could be something anyone can really do. I mean, it's a lot easier than running a syndication and a whole portfolio. So
yeah, I mean, it's wild too. There's some white papers out on short-term rentals from some relatively large companies, relatively large accounting firms, and a lot of them get it wrong. So you gotta really understand what's going on to understand how you can benefit. But it's something that you can totally do. Yeah, and it's all comes back to that cost seg bonus depreciation and non-passive losses.
It always comes back to that, right? I mean,
Yeah.
That's always the common denomination, wherever I am. But no, someone else asked a question over here. If your income from real estate is rental income plus real estate capital gains, is everything passive income? I'm not sure.
Well, so it doesn't matter where your income comes from, right? Remember, all rental activities are passive. Every single rental activity is passive, unless you have a short-term rental activity and you're outside of the scope of Section 469. All other rental activities are passive, right? That's the default. The only way to make them non-passive is to either earn less than 150K and you get that 25K loss allowance, or you qualify as a real estate professional for tax purposes and you materially participate in the rental real estate activity. Then you have a non-passive activity. So that's what we're looking. Passive versus non-passive is based on the hours, based on the participation. It's not based on the level of income, unless you're looking at that passive activity loss allowance of less than 150K. However, well, not a however, and if you only earn, and this is kind of a unique case, Joseph, sorry, nicknamed you, and I've been trying not to do that. You're supposed to ask people, can I call you by your nickname before you just do it? Anyway, Joseph, if all of your income is from rental real estate and capital gain income, then you might go, well, why do I care about the non-passive treatment? I might, if it's all passive, it doesn't matter to me because it all offsets and I'm good, right? But if you have positive net rental income, positive capital gain income, and it's, I believe, 250K plus, then you're also subject to net investment income tax that was implemented with Obamacare. It's an additional 2.9% tax. Maybe it's 3.8%. There's an additional tax on your passive activities. So qualifying as a real estate professional, depending on how much income you earn, qualifying as a real estate professional could still be beneficial for you. We typically look at that when people are netting about $500,000 or so. And then we go, okay, you need to qualify as a real estate professional to mitigate this tax. It's going to save you 15 grand a year or something like that.
Awesome. Okay. Brad, it's been incredible. Very insightful as always. Any more questions? Because now would be the time. I think you covered some really key points, especially those relating to the CARES Act and real estate professional, which is always, like you said, a hot topic that most people get wrong.
Yep. And where do most people get it wrong? Let's talk about that real quick. So taxpayers get real estate professional wrong typically in one of two ways. They forget to do a time log or they do it retroactively. You will lose almost every single time. So don't do that. Make sure that if you're going to go this route, that you are really diligent about it. It's going to pay off. Your effort will pay off. You will get the tax savings that you're looking for. It's going to be substantial. So put the time and effort and energy into keeping that time log on an ongoing basis. That's mistake number one. People don't do that. The other mistake is that taxpayers are unaware that they need to make an election to aggregate their rental activities into one activity. If you don't do that, and it's called the 9 election, but if you go to your CPA and you say, I need to make the 9 election or the aggregation election for my rental real estate portfolio, hopefully they know what that means. But one of the mistakes that we always see advisors make is not making the 9 election. So you need to make sure that the 9 election has been made. It's a statement that you attach to your tax return. It's not something that's in one of the forms. You have to attach a statement to your tax return. You only have to do it one time. And then every additional property is automatically grouped in. It's automatically aggregated in. But when you make this election, what happens is you only have to materially participate in all of the rental activities. If you don't make the election, then what's going to happen is you're going to have to materially participate in every single rental activity separately, right? Which, if we think about that 500 hour, that safe harbor rule, that's 500 hours per rental property, which is going to be very difficult to do. And that's where the court will typically stick you. So make sure that you make that 9 election in that first year.
Is there any reason why someone wouldn't, other than an erroneous, error by themselves or the accountant, why they wouldn't make that election?
Yeah, typically we see that it's just done in error, like it's a mistake and somebody forgot to do it, and that's a big bummer. But there would be one key time that you would not make the 9 election is if you have a lot of suspended passive losses. If you have a large amount of suspended passive losses, the 9 election might actually hurt you more than it helps you. But then we're also going to say we might not even qualify as a real estate professional, and we might not have to materially participate because we might just have too much suspended passive losses. Typically, folks with like 6 figures of suspended passive losses will kind of really do some analysis and try to figure out what's going to make the most sense for them.
Mm-hmm. Okay. And one more question on that I've been asked before, and just love to get your opinion on this as well, is someone who is and we discussed this beforehand, and I think it's kind of relating to this aspect as well. But we mentioned, the GPs and people who are in syndications, and they're involved, and some of them are yes, and some of them are not. So before I get to my question, I just want to say, someone asked over here, does market analysis or underwriting count at all towards those hours on real estate professional status?
Yeah, good question. So sometimes, but my typical stance is no. And the reason for that is I could underwrite 1,000 deals and not close on one. I'm not going to be a real estate professional for tax purposes, right? I need to have the property, or I need to be moving deals along. So if you are spending a lot of time analyzing the market research, let's say that you go and travel to the property and walk it, and we'll tell you track that time. But if you don't close on that deal, then we're probably going to say, it's just not going to fly. Now, if you're doing this full time or a significant amount of your time, and you're closing on a deal, once every 2 months or something, and this is like your business, that's a little bit of a different story, right? Like, this is part of your day to day. But if you're just kind of like trying to get into it and you're closing on a deal once every 6 months, even if it's a big deal, we're probably going to say, the time that you spent researching, doing the analysis for all the properties you didn't close on, we're probably not going to count that time. You probably won't need it. Typically what we find is that our folks that our clients that are doing a lot of the market research and all the analysis, all it takes is one deal for them, and then they're just sinking a ton of time into managing that deal.
Yeah.
Up front, that's not going to count. We'll tell you to track it, though. We're not going to tell you to throw it out, right? So track it, but also try to hit 750 without it, if that makes sense. Same thing for education. A lot of people think, if I go to like a networking event or my real estate meetup, then that time counts. That time's not going to count. It's not a real property trade or business time, right? So really kind of think about the time that it takes to actually manage the property, which some education can count towards that, but it's very limited in scope.
So the question that I had related to that was those on the GP side. Okay, back to that question of, I think we will end with this, is in terms of the aggregating of the properties. Okay, let's say that they just have a GP, and they're a GP in several deals. Is the aggregation that they're doing across those properties the same, or is it different if they're, or is it they just have a kind of portion, maybe say a 5% or 10% equity stake in those properties?
I lost your audio for the last half of that, so I'm going to assume that I know what your question is. Okay,
let me rephrase that. Let me rephrase it. If someone is a GP and they have, let's say a 5-10% equity stake in each deal, are they aggregating those activities across all those, or is there a certain threshold in terms of how much equity or how much they need to be owners of those properties?
No, yeah, good question. No, if you're making the aggregation election, every single rental activity is going to be aggregated into one. So so all the GP stakes would be aggregated into one. So that general partner in that case they could spend zero time in 4 of their deals, but then be the lead sponsor on one deal and hit real estate professional status and material participation status on that one deal. They're going to aggregate in the other 4 that they're passive. And this is maybe a little bit of a better way to kind of describe it is like we work with a lot of folks out in San Francisco and New York City, and they're earning a ton of money, and they're investing as a limited partner in all these syndications, and they go, well, I want to take all the losses. Well, if you want to take the losses, you got to build out your own rental real estate portfolio. You have to qualify as a real estate professional. You have to materially participate in your own rental real estate portfolio. Then you can make the 9 election, and you can aggregate in the limited partnership interest at that point, which is cool because if I've got my own rental real estate portfolio and I qualify as a real estate professional, I materially participate, and I just need a boost of, say, $100,000 loss or whatever in any given year, I can go take $100K, put it into a syndication. They're going to do a cost study. They're going to pass me 95 to 100K loss back in the first year. So it gives you flexibility to kind of control your taxable income if you build out your own rental real estate portfolio first, qualify as a real estate professional, materially participate, make the 9 election. Now I can go and be very strategic with the limited partnership interest that I place.
Awesome. Amazing information, amazing delivery as always. Also, Brandon, appreciate that. Any other questions by anyone? Because it is getting a little late, and I don't want to keep everyone here all night like we did last week. Yeah. Okay. So if anyone doesn't have any questions, we're going to just transition into the breakout rooms for a little more networking. Brandon, you're welcome to stay. You're welcome to leave, whatever you want. Everyone's welcome to stay or leave, whatever you want. How we typically do this is we have, I guess, right now 33 people in here. Anyone who's watching this on the Facebook Live, if you want to join the LinkedIn, not the LinkedIn, sorry, the networking on the Zoom, just hit the link over there on the Facebook group, and you'll get brought into the thing here. We're going to break out into smaller rooms. So what we're going to do is I'm just going to hit the button. You're going to see something pop up on your screen that says join room number 1, 2, 3, 4, 5, 6, whatever. And then you'll jump in with another 2, 3 people. What I like to do here, generally speaking, is just to introduce yourself. One really cool thing that I would really like everyone to do is that when you first meet and you're in that group, take a second, open another tab on your screen, open up LinkedIn, okay? And find those other 2, 3 people who you're in that little group room with, and make sure that you connect with them there so you can continue the conversation. Just forget about like, hey, who is that cool lady from Seattle who has those rental properties? Like, I forgot her name. Just connect on LinkedIn first so that way you can continue the conversation later. Okay, so without further ado, we're just going to do that. Thank you again, Brandon. I really, really do appreciate this. And for everyone who wants to jump off next week, make sure to join us. We have syndication attorney Mauricio Rao, who's going to be talking about some cool stuff about securities laws and raising capital and what you need to be aware of. And I think it's going to be some good stuff. So